The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Mathematical forecast of performance, again, very, very important. Why is that the case? Why is this the case that we may have, in terms of importance, a mathematical forecast of performance? We look to define trading performance. Trading performance can be expressed in many ways. However, at its core, it's all about the evaluation of a trader's return, but also an evaluation of trader risk. What I'm trying to say in so many words there, guys, is to be quite frank with you, your mathematical forecast of performance is how much money you make at the end of the month. Now, I have to be quite honest, guys. Again, it's all fun and games when we go through a lot of education here at Forex.Academy. The purpose of our education is to make you a better decision maker, to make you a better trader, to make you trade so that you can make more money in the markets. That's the goal of financial trading. Your level of performance from the guy next to you sitting in the office, if you're a trader, of course, is that you make more money than him. And I have to be quite frank about that. Again, yes, in terms of hedge funds and pension funds, you do want to quantify that level of performance as a function of the risk you take. But again, if you're able to accommodate those risks, and when those higher risk trades turn against you, let them not be so fatal, then you can still look to the guy next to you and say, well, I take a little more risk each month than you, but I make much more money than you. You have to look to mathematically forecast your level of performance, and that's why journaling and taking account of your trading decisions will develop consistency. Okay, if you see that you're starting to develop a lot of consistency, let's say your hit rate is something like 80% and your risk reward is perhaps 2 to 1, say, for example, you're still making consistent profits, but there might be certain trades you'd like to push the boat out on. You could simply change the risk reward to 1 to 1 because your hit rate is perhaps for the last 3 months so high. You're maybe getting a little more accustomed with trading the markets and getting more skilled at it and picking good trades. If you're trading well, you might look to just increase the risk across some trades in the next trading month. And again, this is just because you're making money. You should be when you're trading well and making money, you should be looking to increase those risks. When you're trading poorly and not making money over a week, 2 weeks, you should actually cut down on your trade size until you get a level of consistency back, pick a few trades, get some confidence back in your trading, then hit a trade when it sticks out like a sore thumb, and look to manage your risk. So it's always about looking to quantify performance. And if you can mathematically say over a 6 to 8 to 9 month period, 4%, 12%, minus 2%, 6%, 6%, 10%, 8% over those months, you're effectively trading very well. Again, if you're looking if you're actually scalping the market, you should be outperforming those. That was more related to day trading or technical analysis, looking at daily price action. So try and analyze your performance in terms of the pip gains, the quantitative amount of money that you make over a set period of time for future expectation. So some contemplative questions to ask first. Okay, again, when you assess your trading style, what type of trader are you? What is your approach to risk and maximum drawdown, which is a key question, guys. Can you believe that a lot of retail traders, and again, we've very much with the finish of the Become a Pro lessons there, we've moved away from retail trading. I'd like to think so. We're developing our professional approach here. In terms of a real difference between retail trading and professional trading, that account that you have there, that trading account that perhaps has 5,000 euros or 10,000 euros in it, you're never, ever going to risk a large percentage of that at any one trade. Albeit, you're never going to say to yourself, I'm going to make a fantastic winner on this trade. If not, then I've got the capital to hold this trade. you have the capital, the whole capital on your account to hold that trade. Imagine you were running a sweet shop or a business, guys, and you funded the business. Let's say it's a corner store, a confectionery store there. You put 100,000 euros into it. 4 years ago, it's now profitable. But then you have a new business relationship that can sell, 2 or 3 new products, perhaps some new snacks. Just one section of your shop dedicated to these new products, but it's starting to lose money. But you think it's worthwhile? You're never going to say, "Well, I have put 100,000 euros into this business. I'm going to make sure that this one section is going to make money over the long term, and I can hold this poor investment." That is crazy. You would never do that if you were a corner store owner or some sort of business like that. The same is trading. If you actually were to fund your account with 5,000 or 10,000 euros, now start to trade within 6 months, you have it up to 13,000 or 14,000 euros, you're trading well. Then the equity markets tank, there's a big market correction, and then you believe, oh, the markets have been so strong over this bullish move to the upside over the last 4 years. Now I'm going to make so much money buying the lows of these markets. Like, you take massive risks in the market, but what if that turns into something a little deeper? Perhaps we get some recessionary figures that starts to mull over, maybe a bit of a crisis in the Eurozone here with sovereign debt, whatever it may be. And we see effectively that correction is not necessarily a market correction, but something a little deeper. Or are you going to say to yourself, well, look, I made £4,000 over the last 6 months. I'm willing to bank this trade. I'm willing to bet that this is just a correction, and I'm going to hold this until this comes back. People, in terms of retail trading, always assess their account like that. Their maximum drawdown, maybe perhaps their entire account. That is not the case. That should never happen. Again, that is a real difference between professional trading, guys. Your account is your business. It's your business lifeline, your trading account. It's your capital to allow you to trade, not to take gambles in the market. What are your performance expectations dependent upon your strategy? Are they realistic expectations? Okay, how much profit do you want to make from the strategy in a particular month? Do you adopt a risk-reward ratio to your trading strategy? If so, is it positive or negative? Across which asset classes or markets? What is a realistic win rate? Okay, so if it's a negative risk-reward ratio, of course, you're going to need to hit at least above 50%, guys, at least, to be profitable. What is your own expectation on a trade-by-trade basis? Okay, so judge each individual trade by its own merits. Do you have short, medium, long-term performance goals? Again, do you have short, medium, long-term trading objectives? So if you're a trader, an active trader, and let's say you place 10 scalps or 10 intraday trades during the course of the day. Each day you like to try and get 8 to 10 trades off. And you quantify that, and you know that you're effectively, you trade quite well and you make money over a long, consistent time period doing so. That may be the case. Fantastic. Keep that trading strategy open. But why not look for other medium-term opportunities? Let's say you look at a market and say, well, this wheat market, I haven't traded the wheat in a long time. It's now hit a seasonal turn where there's going to be more demand coming into that commodity, that crop. And I really expect this, with the technical analysis or whatever analysis I have in sight, to trade up 400 to 500 pips in the next 2 to 3 months. Now, if that's the case, guys, you're allowing the term of the trade some breathing space. You could effectively say, well, instead of taking a 0.01 trade and with my daily trade here, I'm going to take a 0.12, 0.12 trade in the wheat market because it's a long-term trade. If it's a 3-month trade, I'm going to give it perhaps quite a large stop loss, of 150 pips for perhaps a 400, 500 pip winner. And it's going to take time to develop. So you want to allow yourself just that option to trade a medium or long-term trade, because that could possibly be a 600-700 euro winner, 2 months down the line. And again, if it's a result of your own technical analysis, allow yourself to profit from your consistent trading strategy intraday, but allow yourself the goal to outperform the markets. And again, if it's just trading up day by day, it's just ticking up, and then there's some pullbacks in the markets, but the market's just trending up. Just filter that trade out. Make sure your risk management is tight. You're mitigating your risk on the trade, of course, but filter it out of your expectation intraday. Don't necessarily look at it every single day, because it might cause you to overthink each trade. If you've got into the trade for a 2-month or 3-month perspective, let that opportunity arise. And again, having the ability to make those short intraday trades. And again, you might have one portfolio where you like to short trade, one portfolio where you like to take 2-day, 3-day trades, and one portfolio where you like to take monthly trades positions. Okay, you can of course do that, and profit is profit at the end of the day. So here again, the importance of journaling or trading reports is paramount to success. Okay, these can provide traders with the key trading performance statistics. Now, what are we looking at here? Again, a couple of questions or points down at the bottom. Do we have profit or loss? Number of winners against the number of losers, the size of the winners and the size of the losers again. Now, what we can see is really an overall profit here of 286, okay, over the long run. 286.49. So that's decent in terms of the term of the trade. Perhaps it's over a week's trading decision, or perhaps a specific day. Again, one thing we can see on account is a simple trading methodology. The guy trading here, it looks like he's just getting in and out of the market. We can see with our 286 guys that one of these trades is the big winner. So effectively he's bought a 0.01 lot in the US Dow Jones Industrial Average. It's been, let me see, is he long or short this market? We unfortunately, he's long this market. There we are. Buy. The market is obviously quite strong on the day. It's traded up quite a few pips, and effectively he's shown and taken profit at 235. So he's really, perhaps this is a day where he's included one of his medium-term trades into his daily strategy. So effectively, if we disregard that trade for a moment, okay, what we can see, 286, okay, we effectively have 46, around 51 euros profit from all other trades. Okay, so intraday, he's made 51 euros, okay, from our loser, our winner here, winner, 11 euro winner, 621 winner, two very small losers, and again, a 960 loser. So not so bad, some good trading again overall, in and around 51 euros profit. And again, perhaps a different opportunity allowed him to trade this order here. And again, he really tried to run this, and he's done fantastic. She has done fantastic on this trade. So again, we're looking at a trading performance statistics. What we need to ask ourselves is at the end of each week, at the end of each month, are we in profit? Okay, of course, that's the most important question. Are we in profit? What's our hit ratio? The numbers against the number of winners and losers. Okay, and what is the size of the risk reward towards those winners and losers? The size of the winners as a function of the size of losers. So these are the sort of questions that we can do simple equations on and towards journaling. Again, nothing too crazy in terms of high-end mathematics, but just to give us an overall insight to our performance, guys. If you see very positive figures over the course of 3 months, how are you going to trade in month 4? I would say very, very well. Methods of system evaluation. Again, it's so important to look to evaluate your trading system. Trading journal, daily, weekly trade performance reviews, which of course I do remember back when I was trading as a futures trader on the demo account for 3 months, 4 months before I went live, trading 9 o'clock. I believe before that, 7 o'clock in the morning to 9 o'clock at night. I would have been on a demo and I would have had weekly trade reviews with the directors of the company. It was a proprietary futures trading firm that I worked for. So, that's way back when, 12 to 13 maybe years ago. And if that's done in a professional light, such as a prop firm, of course, that is something we should do as professional traders individually. We have equity curve monitoring, which you can do, of course, objective performance analysis across strategy. Some strategies perform better than others. We know that's the case. Objective performance analysis across markets traded. So if you have different strategies, you can do that performance. If you have different markets that you like to trade, do that performance. If at the end of the month it tells you, well, look, you're most definitely making more money with actually taking less risk in the Forex markets with your trading strategy, why would you involve yourself in less profitable, higher risk trading strategies if that's the case, if the data is telling you that at the end of the month? And again, maximum drawdown monitoring. Be aware to your overall exposure levels on account, please. Moving on to objectives of position sizing. Again, we have an expectation, okay? Strong data, market prices in May interest rate increase. So this is effectively what we had. This is the market pricing. And if I can just annotate this on chart for you guys, again, we have just one market trade here. This is our trend. It looks very, very unique indeed. This is the cable market, albeit roughly around 1 month ago now. Cable market trading up. We did price in a May interest rate, or the market priced in a May interest rate increase. That did not happen. We've seen the dollar start to really rally. And again, this depreciation of sterling was very significant given there was no interest rate increase. Fundamentally and technically, this broke to the downside. That's what we're seeing, okay? So how do we include our objectives towards the data, towards our expectation, towards how we position size in the market? Do we over or under trade the market? We don't oversize, because we've really seen something that has shocked the markets, or really as the market. Generally, when the market prices in something, when I say the market, I mean the overall market starting to move, a collection of the market participants globally, then we can look to trade those size moves. But if there's a bit of a shock like this and the market has priced something incorrectly, perhaps we shouldn't oversize our trades. Trade at psychology comfortable levels. Okay, so always be comfortable with your trading, of course. Understand notional trade size. Again, it's relative to sizing. Be accurate. Okay, be accurate with the technical break. Perhaps you want to get exactly around the level. You don't want to trade perhaps at a level where the market just moved. Now we're taking a massive short at these levels here. Well, the market's just moved 400 pips. Is this the right place right here to take a massive short position? Maybe not. Be accurate, excuse me, and emulate professional traders. That's what we're trying to do, of course, with the Become a Pro course, in developing our natural approach towards trading the markets just like professional traders do. Introduction into position sizing in terms of developing our evaluation and objectives. We refer to the technical size of the trade or the monetary risk that a trader is going to take on any given trade. Okay, investors use position sizing to help determine how many units of a particular market they can purchase, which helps them control risk and help maximize returns. In order to position size correctly and before the trade is executed, a trader needs to decide how much of their capital they wish to expose in a trade. To do this effectively, they need to consider how much capital they want to assign to each trade, not just one particular trade, but each trade is the key word. What is the trade risk associated with each trade? Again, not just the risk in terms of position size, but the risk, the inherent risk. If you take the same position size, let's say you take a trade in a Forex market, let's say the euro dollar, and the stop loss is 50 euros. Where if you take the same trade in Bitcoin that's moving quite rapidly, say, and the stop loss is 50 euros, that's not necessarily the same trade. We know that. Or perhaps the same trade in the DAX. When the DAX is moving, we only want to assign a 50 euro stop loss. Again, it's simply not the same market, so you need to take that into account, not only for your position size, but the environment or the market in which you execute the trade. And are they calculating position size accurately? So just because you press and execute a position size of 0.04 in the euro dollar, if you execute a trade in euro yen at 0.04, that is not going to be the same, because you're trading euro as opposed to how many. Yes, you're trading 4,000 euros against the dollar and 4,000 euros against the yen, but as the yen moves in relation to its pip location and size and volatility, of course, are you accurately calculating that position size for those markets? So it's really, really important, and this is one of the main focuses on risk management that we like to educate, why position sizing is a crucial part of the effective risk management function. Because knowing how much of your capital is exposed in a trade or collection of trades ensures your initial survival and then impacts your potential for consistent returns. Now, that sounds a little obvious to just come out and say that, but if you can ensure your level of survival trading in the financial markets, well, then you're not going to fear that you're going to blow up your trading account ever. Do you get where we're coming from and how important that is? And again, if you're looking, all of this combines into one another. If you're looking to really sit down and say, I'm going to have an Excel sheet where I'm going to quantify my mathematical performance in terms of the capital or return gained each individual month or week I trade the markets. If you're effectively able to do that, well, then using your trade size again with risk management, you're going to be able to effectively impact on your potential for consistent returns, i.e., forecast future performance. Not only survive, but forecast future performance. Profitability rules again. So what I'm going to do is just walk through a trade. Now, not necessarily a market in terms of I'm going to trade the euro dollar and place this size and this is the move. In terms of in our heads, how we gather an idea to probability, to a rules-based approach, to observing the markets and to calibrating the risks involved objectively there. So do we have personal rules to profitability? Okay, perhaps we do. Perhaps we trade with the Forex, perhaps we trade all the Forex markets with a risk-reward ratio of 1-to-1. Okay, so a simple 1-to-1 risk-reward ratio. We have a constant appreciating effect of trading account size. We have implementation of trade strategy. Okay, this is all a flow, a thought process flow. And then we commit with our ability to stick to strategy and rules. We're consistent in risk position sizing. We calibrate the risks to the markets in question. Again, if we're trading markets that are more volatile, if we're trading markets that are less volatile, if we're trading news flow that is quite egregious in terms of its interpretation for markets, if we are trading simply off technical analysis, and again, off that technical analysis is the risk reward in sight. Are we objective in action and implementation? Again, so once we place those trades, are we totally objective or are we subject to our analysis? We should be more objective, of course, to technical analysis as well in our action. So if the market moves with us, let's say we use a 1-to-1 risk reward again, and for those particular 2 or 3 trades where the market starts to move in our favor, are we objective? Or do we look to say, okay, I was hoping for a 50-euro winner across these 3 trades each, but I'm 20 euros up in each trade, so I'm just going to take 60 euros profit and exit each trade. Okay, effectively, that is not sticking to your strategy. Of course, if those 3 trades were offside, i.e. not in your favor, -20, -20, -20, I would argue that you would not be looking to cut those losers short, all 3 of them. Not even one of them. You would look to commit to your trading strategy. So you should be able to commit to the trading strategy to the upside. So objectivity in action and implementation, stop loss management and risk mitigation. Again, if that market starts to trade or those 3 trades start to trade up to your 50 level, and again, do you have total exposure on the 3 trades, i.e. are your stop losses still at -50, -50, -50? Why don't we move them all into break even? One of them might pull back, but again, you're more likely to take profit over the life of those 3 trades. And probability of fulfilling realistic expectations. So again, we started with your personal rules to probability, and we finished with probability of fulfilling realistic, which is the important word, realistic expectations. So this is the function that we go through, guys, or we should go through. Your personal rules to probability trading and the probability of fulfilling those realistic expectations with rules in sight. Okay, a rules-based approach in calibrating risk, in developing your mindset and trying to follow this flow chart. Okay, I would like to recommend to revise this flow chart here and ask yourself, over the life or distribution of your 100 trades, do you implement this flow chart in terms of your appreciation of the risk involved in trying to capitalize? If so, I would say if you were to do this for 100 trades over the course of the month, you'd have more success, i.e. make more money over the course of those trades in just developing, objectively quantifying your calibration of risk to profit performance and again to probability. Okay, so fantastic, guys. That brings us to the end of bonus webinar 1. Congratulations, guys. We finished off the Become a Pro course. We can look forward to, of course, bonus webinar number 2, which will be delivered shortly, of course. So if that's everything for now, guys, what I'd like to do is thank you very much for joining us here at Forex.Academy. We'll see you next time on bonus webinar number 2. All the best from us here, and Robert here, of course, myself at Forex Academy. We'll see you soon. Bye for now.